Hello, welcome to the inaugural StoneX Annual Outlook live stream. Today we will present our updated views from the annual outlook that we published on January 31st. My name is Kathryn Rooney Vera, Chief Market Strategist here at StoneX. For those who don't know, we are a Fortune 100 financial services firm, which we're proud to say boasts a 28% compound annual growth rate for the past 20 years. In an interesting paradox, we were founded 100 years ago this year by Saul Stone, a door-to-door egg salesman. Yet we have a startup culture where we took $9 million in equity capital 20 years ago to nearly $1.5 billion today. We serve 50,000 commercial, institutional, and payments clients and over 400,000 retail clients. We have 80 offices in 21 countries and more than 4,000 employees, and we provide everything from custody to clearing and execution to securities trading and self-directed investment. Today, we will share our top market strategies across asset classes from our diverse cross-section of analysts that you can see here on the screen. I will begin with our global macro outlook, our economic forecasts, and our top market strategies for the year. Then we will go around the horn with our product experts, which I'll introduce now. We have Steve Gola. He heads up U.S. Treasuries. He'll give us color on rates. Arlan Suderman is our chief commodities economist. Rhona O'Connell heads up market analysis, EMEA and Asia, and she's our precious metals go-to. Natalie Scott Gray is our senior metals analyst, and she looks at the base metals for us. Alex Hodes looks at energy, specifically oil. Josh Cannington looks at interest rate derivatives, specifically for commercial clients. So it's particularly interesting. Eric Rose heads up our head of digital assets. So it'll be fantastic to hear your thoughts today as crypto makes new all-time highs in BTC. And finally, Nick Reese, a new addition to our team, cross-asset investment strategist. All of them are available to take questions at the end of this live stream. So please type in your questions or comments at any point in the presentation. We welcome your engagement. If you have a different point of view, we want to hear it. So let's kick it off. The runaway in risk appetite following the Fed pivot in December discounted into U.S. equity valuations, a continuation of 2023's optimal macro scenario, one of continued robust economic growth combined with disinflation. The StoneX strategy team sees this year as far more uncertain than markets are presently discounting, including a non-trivial risk of reacceleration in inflation if the economy continues to grow at this pace, and or recession. We assign a 60% probability to the U.S. economy avoiding recession in the next 12 to 18 months. And we assume a soft landing as a base case. But the bipolar risks of something else happening are worth preparing for in our view. And that's our bottom line. To benefit from the potential Goldilocks soft landing outcome, we recommend remaining long equities, cyclical risk assets, but hedging with cheap equity index put options and allocating some portion to more defensive sectors and assets in this barbell type approach. The true surprise this year, for me, would be if there were no surprises. So let's prepare for them. Our top picks this year, we like equally weighted S&P 500. This provides attractive relative value and is more diversified from the market cap S&P 500, which, as everyone knows, is motored by the Magnificent Seven. We like cyclical laggards. These are industrials, materials, and energy. And we like small mid-cap value. This is a subcomponent of the equity space that we think can work in a variety of economic environments. Steve will talk a bit more about this, but we also like the 530 steepener. This is a trade that has not yet worked, but we think it will. Hedges and diversifiers, this is kind of the other side of the barbell. We like the S&P 500 index 1 year at the money put options. They're cheap. Why are they cheap? Because there's euphoria in the markets. Defensive, utilities, consumer staples, healthcare makes sense to us in this barbell type approach. We like high yielding cash. It still makes sense. And we like gold, as we'll hear from Rhona O'Connell further on. So here's our bottom line. As goes U.S. economic growth, so too goes risk appetite. So while the U.S. labor market holds up, and thereby U.S. consumption and GDP growth, risk assets should remain supported. A soft landing is historically a rare event, very improbable. And when and if it does occur, they don't last forever. So hence the recommendation to hedge and diversify. For this year, StoneX strategies and research outlook for the US economy is for growth of 1.5%. That's a serious deceleration from last year's 2.8%. And core PCE, we have ending this year at 2.6%. Under a soft landing of slowing growth, we see the S&P 500 ending the year flat. Okay, that's 5,000 for year end. Risks are skewed to the upside if, in fact, this soft landing does manifest. The polar opposite being recession or overheating of the economy would bring additional downside to risk assets. The 10-year we have ending this year around 375. If the economy slows and disinflation continues, the Fed can cut, and they can cut 50 to 100 basis points starting in June or July. The magnitude and possibility of these cuts, however, will depend on economic growth. If we stay at this 3% plus pace of growth on a seasonally adjusted annualized rate of growth, the Fed will not be able to cut to the extent that is currently discounted into markets, if at all. So everything depends on economic growth. Recall that last year, the market started the year expecting 75 basis points in cuts. This was 2023. It didn't happen, but it didn't matter. Why? Because the economy grew 1 full percentage point above its potential rate of growth, which is 1.8%. Meanwhile, the pace of inflation collapsed. So the markets, in my view, are at this juncture anticipating a repeat of this miraculous phenomenon. If it were to repeat, if we were to have economic growth sustained above potential growth by this magnitude, and a continuation of this immaculate disinflation, which would be another miracle, equities would be up another 15 to 20%. The most fatal words in finance, in my view, are this time is different. Maybe finally this time it is. Probability is it's not. So this is what the not too hot, not too cold, perfect outcome has to look like. 1, the US labor market softens, but not too much. Because remember, the labor market has to continue to support the main driver of growth, which is consumption. So as people have jobs, they continue to consume. They consume services, they consume goods. But specifically in US, they consume services. 2, inflation continues to decelerate as lagged rent and disinflation comes through. Very possible. Geopolitical risks and Red Sea supply chain issues go away. If this happens, it's very positive for the disinflationary trend. Finally, growth is supported by lower mortgage rates, which helps housing activity, and the manufacturing and industrial production recession enters recovery. Leading indicators revert positive after 20 plus down months. In this case, the Fed cuts rates based on inflation coming down to avoid trailing real rates becoming overly restrictive. But here's the rub. If the US economy continues to grow at the current torrid pace, the Fed can't cut. If disinflation continues, the stock market won't care that the Fed can't cut. Remember, again, in 2023, markets were anticipating cuts that never happened, but equities jumped double digits anyway because the economy grew. In a word, if the economy and labor markets hold up this year, equities will likely deliver positive returns, even if the Fed can't cut. The risk is that a second year of above-trend growth does not coincide with a second year of disinflation. A resilient labor market and above-target wage growth may keep core services inflation sticky. This has been my view for some time, giving the Fed very tough choices in late 2024 and into 2025. The anticipation of higher inflation could hurt the market multiple in late 2024. In a soft landing scenario, outperformers are the following, in our view: cyclical laggards, equally weighted S&P, and small and mid-cap value. The yield curve steepens into the first Fed rate cut, but then levels off and flattens. High yield outperforms Treasuries. The US dollar weakens on the back of a US global manufacturing recovery. In the no landing scenario, this is where strong nominal growth causes a reacceleration in inflation. The Fed effectively and arguably juiced the markets in December, stoking animal spirits, loosening financial conditions, and boosting the wealth effect. On top of that, a geopolitical event could always shock inflation. The no landing scenario has its own crop of risks. Long end rates rise. The stock market multiple compresses on upside inflation surprises. And this is negative for both stocks and bonds. Under a no landing scenario, no landing meaning economic growth does not slow down, stays strong, and inflation reaccelerates, the Fed does not cut to the extent expected or at all. Worst case scenario, dare I say it, they even hike rates. These are the possibilities. These are the underappreciated possibilities in the markets. So we need to hedge for them. We need to protect. And protecting when the markets are banking on the perfect landing is cheap. So what happens to markets in a no landing scenario? The S&P 500 trades flat to down and bonds decline. With nominal and real rates moving higher, the US dollar rallies, gold and longer duration tips fall. Relative to traditional stocks and bonds, the no landing benefits short-dated tips, T-bills, and high-yield bonds. Now, what's the final possibility? A hard landing. A hard landing, we put at 40%. It sounds very, very high. But the truth is, the US economy is not in or near recession. But medium-term recession risks remain elevated. Remember that in any given year, because of the economic cycle, remember it has its peaks and its trough and everything in between, the risk of recession is always between 15 and 20% roughly. In our view, given some of the classic recession warning signs that remain and that we follow, which are many, recession risk is likely double that. We could see corporate profit margins under pressure this year from an array of things: higher real rates, higher input costs, higher labor costs. In an essence, recession would likely be would have to come in a delayed fashion and more likely next year than this year. What has prevented it from occurring? In my view, it's fiscal deficits. The U.S. economy has posted 7% fiscal deficit off of the 20% highs in COVID. And that has, in my view, pushed off the recession. So what could cause the recession? Fiscal tightening on the margin, exhaustion of excess savings built up during the pandemic. This is something interesting that the San Francisco Fed follows quite a bit, which is the liquidity in people's bank accounts from the pandemic. And that, according to the San Francisco Fed, is set to be completely exhausted in the first half of this year. A weakening U.S. consumer with rising debt and delinquencies, that is currently occurring. And corporate profit margin pressure, induced job cuts could contribute to an endogenous business cycle recession starting in the next 12 to 18 months. So this is that 40% risk rather than the normal 20%. In a hard landing, what's the market strategy? Equities sell off before rebounding. The market is usually down in the first half of recession, but up in the second. Tech leads the declines, defensives outperform. Front end of the Treasury curve rallies as Fed cuts rates faster and further than currently expected, and the curve bull steepens. High beta emerging market equities underperform. High yield bonds underperform. Investment grade and U.S. Treasuries as low credit spreads fail to compensate for defaults. The U.S. dollar rallies on global dollar credit short squeeze. Gold outperforms within commodities. So those are the three scenarios that we're seeing and how the markets can potentially react. So to take advantage of the current situation, which is the Goldilocks momentum, we are recommending maintain exposure but protect for a possible downturn by hedging with put options and or adding in some defensive sectors such as healthcare, staples, and utilities. Gold and high-yielding T-bills also benefit a portfolio that has enjoyed the 2023 equity run. Now, turning to the U.S. economy, we expect a meaningful deceleration this year, as I previously mentioned, to 1.5% from the 2.8% last year. The U.S. consumer is much healthier than in prior years, that's for sure, not over-levered and currently experiencing, this is the most important point, real wage growth. That is clutch. Where we see potential weakness is in the delayed impact of Fed tightening. COVID-era stimuli dissipating, going away, and rising credit card and delinquency rates, which is a phenomenon that we're already seeing happen. The U.S. consumer has been shielded pretty dramatically by generous government transfer payments during COVID, mostly exhausted or exhausting now, and U.S. fiscal deficits more than 6% of GDP. Home equity values are surging. That has also helped. Thanks to years of low interest rates and a very accommodative Fed, 92% of homeowners are shielded from 8% 30-year mortgage rates. 92%. Student loan debt repayment delay has been very helpful, and job hoarding by companies because it was so hard to hire during the pandemic. If mass layoffs start as companies try to shore up their margins, discretionary consumption follows suit. Our 2024 core PCE forecast is for 2.6%. That would be an improvement from 3.2% at the end of 2023. However, focus is on the service sector component. Services are less directly affected by Fed rate hikes. So some inflation risks remain, and there could be a stickiness there. 525 basis points in tightening has not had a meaningful impact on the US consumer yet. What are other global risks that we're seeing? According to the IMF, and I think it's relevant to incorporate the risks that they see from their World Economic Outlook, the most recent one published late last year, the number one risk they see is from China. Real estate crisis could deepen further in China, an important risk for the global economy. They see while both underlying and headline inflation have decreased, they remain high, and inflation could become entrenched. They share that view with us, requiring even more forceful action from central banks. That's a risk. It's not our base case, but it is a risk. And fiscal buffers have eroded in many countries. Debt levels are surging. Look here in the US, rising funding costs, slowing growth, leaving many countries more vulnerable to crises, and demands a renewed focus on managing fiscal risk, which is very unlikely in an election year, but still required nonetheless. And then despite the tightening of monetary policy, financial conditions have eased in many countries. The danger is of a sharp repricing of risk, especially for emerging markets. That would further appreciate the US dollar, trigger capital outflows, and increase borrowing costs and debt distress. To this end, institutional investors, in our view, may choose to play it conservatively this year, maintaining long exposure but hedging their bets. This upcoming phase of the Fed cutting could take many different iterative routes, so be prepared, including a less than benign one. So what are the investment strategies? We'll move on to fixed income here, and then I'll pass it off to Steve Gola and come back to equities. In terms of fixed income, we expect, just to give you a little bit of background, QT to end back end of this year, but that will depend on the evolution of bank reserves and Fed reserve repo facility balances. Structural forces, in our view, will likely take the long bond term premium higher, given the shift towards price-sensitive buyers, domestic private sector, versus price-insensitive buyers, and due to higher fiscal deficits. So the term premium, we do think over the long run, is going to be structurally higher. Why? Because countries with large current account surpluses, China, Russia, Saudi Arabia, are less interested in financing the U.S. borrowing, less interested in treasuries. Doesn't mean that they're selling them, doesn't mean that they're not going to buy them anymore, but the data show that holdings by these countries are decreasing. In color provided to us by Van Eck from the IMF meetings in Marrakesh, by sanctioning Russian holdings of U.S. reserve assets, the U.S. sent the message that treasuries were no longer a safe investment for central banks that were not in the U.S. friend zone. So China is switching to holding commodities as reserves. So the risk here is without price insensitive central bank buyers. These are buyers of treasuries that don't care what the price is versus we private market guys. More of the burden falls on private sector, the bond vigilantes, both domestic and foreign, who are highly price sensitive. So on the short end, when we look more on the short end, which is I'll pass it soon to Steve Gola, short-term yields above 5% have brought in record flows to money market funds. Money market assets stand at an estimated $6 trillion. When the Fed starts cutting rates, the debate amongst us strategists is, where will that money go? Will that money look to lock in higher current yields in a similar asset class to money markets, such as the 2 to 5 year Treasury market, or will it go to equity markets? My money is on that money, those flows moving into the short duration U.S. Treasury market, because money markets, if the Fed does cut this year, face that reinvestment risk, while the Treasury market benefits from it. Earlier this year, in January, the Fed funds future market was pricing some 90%. Everyone on this call will remember this. 90% probability of the first cut would be in March, this month, and that the Fed would cut 150 basis points in total. At StoneX Strategy, we recommended fading that view, and we expressed that in a published research note via put spreads in March SOFR contracts, betting that there would be no rate cut in March and no rate cut in the first half of this year. This trade returned theoretically some 200%. We think the Fed holds until June, and if 2024 pans out as a continuation of 2023, don't discount a reacceleration in inflation. We like the steepener trade, specifically the 5s, 30s. This trade at this point has not panned out, but we do think that it has upside heading into a slower economy, and if effectively the Fed is able to cut. The average move ahead of a Fed cutting cycle is to steepen 40 basis points in the 3 to 6 months leading up to the first rate cut of an easing cycle. The forward curve is discounting 530 steepening, but not enough compared to history, and even more so if you consider the fiscal deficit is really structurally higher, pressuring supply demand in the context of Fed QT. So steepness levels, in our view, we think can be even better. And with that, I will pass it to Steve Gola to talk about rate strategy.
Thank you, Kathryn. And I'm going to pick up on some of your themes of, well, of course, the steepener, but then also themes of economic resilience to talk about, a less talked about catalyst for steepening of the curve. When I think about positioning for the medium term, I always find, history a bit instructive. If not the answer key, it's helpful in any event. And so I actually thought it would be an interesting exercise to run or take a look at the 2007 experience. I hope nobody thinks about the GFC when I say that, but I think it's an important or a valuable period to look at, in part because the funds rate was virtually identical to the current funds rate at a peak of 5.25% back in 2007 versus 5 3/8 today. And also there was a similarly long on hold period. I mean, the average on hold period before an ease historically is around 8 months. The 2007 experience was 15, and we're inching our way there. In any event, the picture in front of you, that red bar is the funds rate during the 2007 period, with the stair step down being the first ease in 2000. I believe that was 2008. And then the other lines are the darker lines are the 10-year yield. The lighter lines are the 2s, 10s curve. The curtailed lines would be the current environment, whereas the extended lines would be the 2007. And there's a couple of obvious things in this chart, one of which is that current yields, 10-year yields in particular, are some 40 basis points, on average, looking at that chart, below the 2007 experience. And then, of course, I think we all know that the curve is much flatter today than versus the 2007 experience. And so, I begin by saying, how am I supposed to interpret the flatness? What is the market and yields? And, what is the market trying to tell us? And there's, with respect to the flatness, at least, there's two potential, at least, interpretations. One of which is that the Fed is particularly restrictive in its policy stance right now. The other one being perhaps market perception of long-term growth potential is lower than it was in 2007. With respect to restrictiveness, it's hard to say with a straight face, to be honest. When you look at where gold is today, stocks all-time highs as well. Thinking about nominal GDP today, 270 basis points above 10-year notes, versus the 2007 experience was about 100 basis points above. To me, that shows relative easiness in today's policy stance compared to 2007. And then, of course, as Kathryn mentioned, financial conditions were nearly where we were at the end of 2021, which was some of the easiest conditions in the last several decades, in fact. And so, my interpretation instead, especially looking at the lower yields in terms of 10-year yields, is that the market has this belief that long-term growth potential is lower than it was back in 2007. It's that portion of the trade that I think is presents an additional opportunity for the steepener. When we think about how the curve reshapes, there's traditional forms, there's non-traditional forms. With respect to traditional forms, the curve can flatten when the Fed hikes aggressively, as they did in 2022 and parts of 23. Obviously, in traditional form, steepening and excuse me, steepening in the reverse case. I think more recently, the concept of avoiding a passive tightening, additional potential tailwind for the steepener. But it's really the non-traditional form that I find interesting, and perhaps a rethink by the market of what long-term growth potential actually is. And I think a lot of data, in particular the labor market of late, is raising a lot of questions in the market's minds. And so for this reason, one thing in particular that we're doing, in addition to holding and maintaining steepening exposure, is adding a short base, on top of this positioning. And we think collectively, it provides a really interesting return profile, in the sense that, to the extent the market wants to behave and the curve wants to behave in traditional form, where the front end is leading, any curve movements, having a short, in our case, we're thinking, 15% duration short against, if you're running 2s, 10s, 10% if you're running 3s, 10s. But having that short is a great protection against a possible traditional move. It's not what we're necessarily arguing for here, but to the extent it happens, it's a great hedge against that, and enables anyone to maintain their steepening exposure, perhaps longer than they otherwise might. To the extent that traditional move again, but in reverse direction, where there is cause to ease. I very much believe that the curve will, especially in the current environment where we do have what seems like a resilient economy, and somewhat stubborn inflation, this will be the last percentage point will be the hardest. Certainly, I think the steepener would outdo the duration, and so the return profile is interesting in the traditional sense, but then also in the non-traditional sense as well, to the extent that it is a rethink of long-term growth potential. The bear really picks up the trade here. There's the ultimate response for the cumulative portfolio in this bear steepener, is going to be Fed dependent. I do think, as I said, to the extent it's the rethink, the bear wins out, but what the Fed does will dictate whether this is a nicely hedged trade, to the extent that, if, for example, there were sharp hikes for any reason this year, you'll be glad that you have some short on against this. I think that's a very unlikely situation. I mean, the Fed has proven time and again that they're, much slower to hike rates in general than to ease rates. I think that's still the case. They've described themselves as restrictive still. To the extent that the Fed were to, put in a slight adjustment, 1 to 2 hikes this year. I know it's still certainly an outlier view. I'm not sure how the market necessarily behaves, how the curve behaves. It may or may not. Flatten in that scenario, as the market continues to wonder how committed they are to actually tackling inflation if they're only putting in 1 or 2. And then lastly, I think obviously the slam dunk scenario is where the Fed kind of reiterates or revisits this transitory idea, and while inflation is not coming down, they the curve would almost certainly in that case bear steepen. So you're winning on both sides of the trade, both the curve and the duration as well. So from our perspective, interesting hedge. At the same time, you have the possibility of winning on both sides of the trade, and it's how we're positioning here on the rates desk.
Thank you, Steve. On the equities front, we favor a barbell approach of cyclical and defensive sectors, namely industrials, materials, and energy for cyclicals, and utilities, staples, and healthcare for defensives. The S&P is verging on 3 standard deviations from its 1-year moving average. And we think, and you can imagine from our year-end S&P 500 forecast target, that there is some volatility in the pipeline. Equity risk premium and valuations, both in the US and Europe, carry very little room for error, in our view, in the event of some earnings weakness. So we like to hedge exposure here, which certainly detracts from the upside, but puts a floor on the downside. It costs about 4.5% to hedge the S&P 500 at the money for the next 12 months. Turning to technicals, following a major breakout, this is a positive side. The 1-year forward return is on average 15%. This analysis suggests that risks of the S&P 500 price target of 5,000 are skewed to the upside in the event that this perfect scenario does in fact pan out. Odds again are that something is going to go awry rather than the utopic market outcome that's currently priced in, but yet to be seen. Outside of economic recessions, back-to-back earnings declines are very rare. Last year's 24% return for the S&P 500 was driven by multiple expansion, thanks to the favorable combination of economic growth and disinflation, and anticipating a double-digit earnings recovery this year. In a soft landing, earnings likely grow, but the market might rise less than earnings grow, implying some modest multiple contraction. Market consensus and analysts continue to be overweight mega cap growth, recommending at current levels tech, discretionary, communication services. Cyclicals and defensives, or laggard cyclicals and defensives, are out of favor, especially industrials and materials for cyclicals, and utilities and consumer staples for defensives. You can see on the visual here, which outperform in different points of the economic cycle. So it's very important to consider the macro picture when you're investing in sectors, because those sectors historically prove to be very reliable in terms of their performance, depending on at what point we are in the economic cycle. That's why jobs like mine are really, the tricky part is seeing where are we in the economic cycle. Utilities, regardless, are likely one of the beneficiaries of infrastructure investment and fiscal policy tailwinds. In 2022, small and mid-cap value, this is the S&P 1000 value index, outperformed large cap growth, even in a bear market. And that was with rising inflation and interest rates and recession fears. They also outperformed in 2008 and again in 2000 to 2003. So we think small mid-cap value can work this year under a variety of macro scenarios. Now, international, we get this question a lot. Our in-house US dollar valuation model suggests that the US dollar in structural terms is overvalued, and is overvalued by 20%. And in the 93rd percentile of historical relative PPP, purchasing power parity, versus its G10 peers. A weakening dollar is, as we all know, a huge tailwind for international stocks. They can't even outperform without it relative to US stocks. So that would have to occur. Emerging markets have underperformed the S&P 500 and the MSCI World ex-US Index since the beginning of COVID, since the end of 2020. So under a soft landing scenario, EM does well. Emerging markets does well. Latin America broadly benefits and has benefited from the nearshoring phenomenon, especially Mexico, and the economic resiliency and robustness of the United States, and has benefited from the ongoing deceleration in demand from China, although it is recovering somewhat. We like Latin America. It benefits from judicious, proactive monetary policy, and that allows them to cut rates now, having started their hiking cycles a year before the Fed. So they did their homework and they got it right. LATAM benefits from favorable growth differentials versus developed markets, the possibility of weakening US dollar from current levels, and Fed cuts later this year, if it does occur. Indian FX, equities, and fixed income stand to benefit from big sponsorship inflows. If it's not on your radar, India is going to enter into the Global Bond Index, GBI-EM, later this year, which will have important repercussions. China may be our most out of consensus call. China has fallen out of favor in the investment community, and it's generally considered uninvestable. The equity market's underperformance since COVID has been massive, 30% down since end 2021 to end 2023. In our most contrarian trade idea, it's tactical in nature. We published this January 31st. We recommended a tactical long on Chinese equities, specifically in consumer discretionary, expecting a relief rally. Discretionary is up 10%. General index is up 8%. To this day. From forward earnings estimate perspective, the MSCI China Index had never been that cheap versus the S&P 500 when we put that recommendation on. Finally, U.S. presidential elections. We get this question a lot. I got to touch on it. It's rare that a former U.S. president runs for re-election after having left office. The only president with non-consecutive terms was Grover Cleveland. In November 2016, Donald Trump won. It was a shocker. The biggest winners were financials, industrials, energy. The losers, utilities, staples, real estate. Most of those are rate sensitive or growth sensitive. In terms of style factors, small cap and value outperformed after he won. The 10-year yield moved from 183 to 238 in the month of November, and the dollar was up 3% for the month. Our best guess is that a Trump win, if it were to occur, would likely again be perceived as pro-growth, maybe inflationary, I think inflationary, and protectionist, so US dollar positive, with rates higher than under a Biden win, which would be business as usual. In FX, US dollar, longer term, the dollar is likely going to be in a secular bear market. It may have started in late 2022. Under our base case scenario of some softening of the US economy, the dollar likely weakens versus the majors. However, under the hard landing or this robust no landing scenario, which is every day increasing in its possibility, the dollar strengthens or holds steady. In the first case, global dollar credit short squeeze, when credit spreads matter more than rate differentials, could push the dollar higher. In a no landing scenario, rate differentials likely support the dollar, but get partially offset by continued US and global growth. The euro. In addition to interest rate differentials, the euro tends to be driven by the Italian-German 10-year yield spread and the Italian-German 10-year bond correlation, both of which are currently benign, and both suggest little existential risk to the Eurozone or the euro. The Eurozone terms of trade are improving, and the Eurozone is back to running significant trade surpluses. The medium-term fair value on the euro, we estimate at StoneX, is likely around 120. And finally, the yen is likely to broadly strengthen this year as the Bank of Japan moves away from negative interest rate policy. We have a constructive yen view. Terms of trade have improved dramatically for Japan with the decline in oil and natural gas prices over the past year and a half. And in particular, we're monitoring the Swiss franc Japanese yen cross with the expectation that eventually there will be a significant valuation mean reversion move in this pair. And we think that could start at some point this year. And with that, I will turn to the estimable Arlan Suderman, who is our chief commodities economist, and he will give us his views. Arlan?
Thank you, Kathryn. I want to cue on a couple of things you talked about. The first would be inflation, reinflation, or disinflation. And the second one is going to be talk about some geopolitical risks that we want to be monitoring going forward this year. First of all, on inflation, you see here in front of you a graphic that shows our StoneX commodity index tracker, tracking a basket of commodities from across the various major sectors versus the 5-year break-even inflation rate. And what we find is that the managed money tends to want to be long or create ownership of the commodities during times when they believe that inflation is trending higher. But as you see from June of 2022, they've been shorting the commodities. And that's not true of every commodity, but the sector is a rule. The exceptions would be those individual commodities that have a story. For example, cocoa, which prices have been going crazy there because of weather and disease problems with the crop. The protein sector, live cattle, lean hogs, because of declining supplies due to weather decreasing the size of the cattle herd in the United States. Crude oil at times because of geopolitical risk. Otherwise, they've been shorting the commodities because of expectations that inflation is trending lower. But you see that the 5-year break-even inflation rate is starting to trend sideways and starting to trend a little bit higher. Don't know if we're going to get a breakout out of it yet, but it's starting to trend higher if, in fact, we see that there tends to be about a 2 up to 3 month lag in being able to see the money flow change into commodities. Then how does that tie to the CPI? The CPI tends to lag 2 to 3 months behind that. So a close correlation, even though there are other factors obviously that go into the CPI. So we're watching that disinflation, reinflation question going forward for the commodity sector. The other thing is geopolitical risk. I'll divide that up into 3 categories. First of all, Red Sea. Right now, that's interrupting shipping, doesn't change the supply, increases costs. Another 10 to 15 days to go around the southern end of Africa. That's inflationary in nature, doesn't change the supply though. Black Sea, both Russia and Ukraine have the ability to sink a ship. Neither wants to do that in the world public opinion right now. If either one gets desperate enough to win this war and starts doing that, that's a game changer. Number 3 is China, where tensions are increasing. China has been rebuilding its stockpiles of essential commodities. Just released today plans for committing more money toward doing that, up 8% from last year. Are they going to make a move on Taiwan ahead of the U.S. presidential elections? That's a possibility. Black swan event. That would be bearish. The first 2 are bullish to commodities. The last one is bearish to commodities. With that, I'll turn it back over to you, Kathryn.
Thank you very much, and everyone. I will remind you that we have you can ask questions, and if we do not have time to get to them, we will reply to them via email. And with that, I'll turn to Rhona O'Connell. She will be focused on gold and silver with a nod to platinum group metals. Rhona.
Kathryn, thank you, and welcome everybody. I'm sure no one has missed the fact that gold's hit the headlines this week with this morning's LBMA AM auction price posting a record high of $2,126.25. But just to give you a sense of perspective there, in real terms, basis the US CPI as a deflator, the $850 intraday price of 21st of January 1980 equates in today's money to just shy of $3,400. So we're actually still 60% off that peak in real terms. So historically, gold has been viewed primarily as an inflation hedge, but it's actually much more important as a risk mitigator. For the past couple of years, obviously, interest rate expectations have been an important driver, and the FOMC meetings have held center stage for a long while. But now, with the cycle seen in many quarters as potentially changing, although obviously, as Kathryn has talked about, that's not necessarily going to be the case. With geopolitical tensions rising, and I would note here that one area where members of the banking fraternity are seeing the greatest risk is the number of elections that we've got globally this year, which is bordering something like 50, be they regional or national. And my big hobby horse is lurking banking stresses, particularly in the small to medium sector, and that is global. So you put all those together, the tailwinds for gold are stronger than the headwinds, and especially also if the dollar starts to come off. Meanwhile, the COVID meltdown table at top right on the slide demonstrates how gold can be robust in times of crisis. Initially, almost invariably sold off as investors use it to generate liquidity, and it's then equally almost invariably bought back once the dust starts to settle, and wealth managers in particular rebalance after any distressed selling. And finally, 6,000 years of history can't be ignored. If you look at the bottom right, you'll see the different ways in which people find gold attractive and why they're lured to it. It all started, as I say, 6,000 years ago, with the quest for beauty in Egypt, and gold was alluvial. There was a lot of it about. And that has ultimately led to its current pivotal role as a mitigator of risk, from high-grade jewelry throughout the ages to central bank activity and right across to financial derivatives. Meanwhile, silver has a strong correlation with gold, but it's not a safe haven. I cannot stress that enough. Silver is not a safe haven. Prices can be very volatile. Sharp silver rallies are almost invariably followed by much steeper and sometimes vicious decline. It's often called a precious metal because of its history and coinage, but over 60% of its fabrication demand base globally is industrial. Also, while only 31% of mine production is from primary silver mines, and when you feed scrap return into that equation, then that proportion falls to just 22% of supply, we more or less obliterate price elasticity from the supply side as far as the silver market is concerned. The longer-term outlook for demand is very strong, revolving around the solar industry, which will take prices higher through this decade. For this year, we're forecasting just a small surplus of less than 3 weeks industrial demand, so that's actually more or less in balance, And that surplus should relatively easily be absorbed by investors, although for the time being, they're still shunning the market. Just a quick comment about the PGMs. The net zero carbon emission targets are undermining platinum to a small extent, but the current outlook for palladium and rhodium over a 10-year view is frankly dire. The auto sector's internal combustion engines currently comprise over 80% of both palladium and of rhodium demand. That's on a gross basis before we start thinking about scrappage. But if the vehicle fleet electrification programs hit their target dates, which has frankly to be questionable, then the auto sector will, by 2038, be a net supplier of metal into those markets. Not an 80% demand sector, but a net supplier. 2038 might seem quite a long way to you and me, but if you're a mining company, then it's just around the corner. And with that, I'll hand back to Kathryn.
Thank you so much, Rhona. Very colorful and interesting. I love the silver is gold's naughty sibling. Very funny. And with that, we'll go to Natalie, please, with base metals and your impression on the demand from China for those base metals.
Thank you, Kathryn, and good morning, good afternoon, everyone. So coming to the base metals, the title that I've given for this sector is Near-Term Pain, Long-Term Gain. Now, in simple terms, the reason why I've said near-term pain is the fact that this refers that base metals on a year-to-date basis have held the position as the second worst performing commodity asset. And if we look back over the last 2 years, base metals maintained the position as the second worst performing commodity asset in 2023, and then the worst in 2022. Now, the key driver behind this has arisen from base metal prices being dictated by global macro forces or headwinds over fundamentals. Therefore, we forecast that understanding global macro drivers will be central in forecasting future price performance. Now, in this vein, if we break down 5 key macro drivers this year impacting the base metals, in our view, on downward risks, there is a potential for an escalation in geopolitical tensions given the number of general elections this year, which Arlan alluded to. On the bearish to neutral side, we see global manufacturing being unable to return to pre-pandemic levels, while cuts in interest rates will have a lag on consumer appetites. And then on the neutral to bullish side, we forecast a weaker dollar and moderate outlook growth for China. All in all, resulting in the macro drivers tilting modestly to the downside in 2024, particularly in the first half of the year. Now, coming on to the fundamental side of things, base metals have end users which are widely spread across the industrial world. And our key takeaway here for the year ahead is that we forecast demand growth from traditional end use sectors, which makes up on average 90% of demand, to remain muted, offsetting forecast double-digit growth from the green transition, which averages about 10% of demand. Meanwhile, turning to production, despite a flurry of supply-side tightness stories emerging in recent months, particularly for metals like nickel and copper, on a global basis, we're forecasting, with the exception of tin, that market balances across the suite will either maintain or expand upon surpluses, resulting in an overall weakening within the fundamentals. Now, in our final slide for base metals, it's absolutely critical to point out the impact that the green transition is having on the base metal market. Firstly, not only is each base metal of the suite finding applications within the green transition, but it's changing not only the speed of demand in our forecast, which you can see in the chart on the left-hand side in the example for copper and aluminium, but also the underlying fundamental structure. And we can see the example on the right-hand side chart in the case of nickel. And the key take-home message here is that towards the end of this decade, rapidly growing demand from the green transition for these metals will result in structural shortages in supply, with base metal prices forecast to rise to new record highs in the years ahead. And I'll pass back to you now, Kathryn.
Fascinating. Thank you very much. And now we will pass it to Alex Hodes, who will talk to us on the outlook for energy prices. Alex?
Hey, Kathryn. Thank you. And 2024 is set to be a push and pull between OPEC production cuts and Western outperformance in terms of production. This is kind of echoing what we saw in 2023. 2023, really the market was supported by OPEC production cuts. Over the weekend, they extended production cuts that were taking place in Q1 of this year through Q2 of 2024. So this will be supportive of the market in the near term. This has also flipped the expectation of the second quarter, which was originally expected to be a surplus of oil globally, is now flipped into a deficit. But going forward, U.S. production has consistently outperformed expectations, so that will be a risk to the downside in terms of prices. But ahead, we will see that Red Sea supply disruptions will continue to disrupt the markets, particularly from Middle East transport into Europe. And Libyan oil production is at risk, in addition to Iranian crude oil exports. However, this market differs from 2021 in that the supply on the sideline, particularly coming on in terms of OPEC production, it's at its highest level since 2021. So if there are price spikes in the near term, which we expect there will be, Saudi oil production can bring that, or Saudis can bring that oil production back to fill those gaps. So we do see high prices and with a risk to the upside of $95 per barrel in the near term. However, where it's more likely that $82 per barrel will be the average for 2024, with the latter half of 2024 becoming significantly less tight than the current oil market. And that's mostly due to OPEC supplies. Handing it back over to you, Kathryn.
Thank you. Thank you very much, Alex. Really, really interesting on the oil front, and we concur on the strategy team. We have a 82 price target for WTI oil. Eric Rose, he is in charge of Bitcoin, and I'm excited to hear your comments today after this really robust risk-on rally that's taken Bitcoin to new highs. Eric?
That's great. Thank you for including us, Kathryn. And I'd like to say that I'm in charge of Bitcoin, but I certainly am not. I can wax poetically on the Bitcoin as a currency or a store of value or political ideology, but I actually want to focus today solely on supply-demand imbalances that we see and why that could drive prices significantly higher over the near and medium term. The launch of the ETF has certainly been a success, and we think that demand from the ETF product alone is enough to drive prices higher. I would start with saying that, as we all know, there's only 21 million Bitcoin that will ever be mined. Of that, approximately 19.5 million have already been mined, leaving new supply of only 1.5 million coins to be mined over the next 100 years. Of the 19.5 million in existence right now, an estimated 3 to 6 million of them have been lost due to lost keys or seed phrases. And according to CoinGlass, approximately 70% of Bitcoin has not moved in the last year, meaning original holders are not interested in moving their tokens at this point. That leaves approximately 1.2 million Bitcoin for available on exchanges. Looking at the demand side, since their launch on January 10th, newly launched ETFs have added 350,000 Bitcoin. This has been offset by redemptions and selling of 200,000 Bitcoin from GBTC, which held over 650,000 Bitcoin prior to its conversion to an ETF. All told, all of the ETFs now hold over 800,000 Bitcoin, which represents approximately 4% of total supply and almost $55 billion notional. At the current pace, ETFs are buying approximately 5,000 to 6,000 tokens per day. This is contrasted by new issuance of approximately 900 tokens per day. In April, we'll experience the next halving, which occurs every 4 years, where the block reward for miners goes down by 50%, going from 6.25 Bitcoin per block to 3 1/8 per block. This brings our new supply down to 450 per day. Now, can the demand dynamic continue? We certainly believe so. We point to buying from institutional asset managers and RIAs as the growth source for demand. If we just look at the RIA market, which is estimated to have $5 to $7 trillion of assets, a mere 2 to 3% allocation could bring $120 to $200 billion of new buying power alone. We note that many asset manager platforms have not yet been approved for adding Bitcoin ETFs to either their allocations or their trading, and we do expect them to come on board over the next 2 to 12 months. Focusing on ETH, as the second largest digital asset and the potential for that demand imbalance. We look at the ETF approval, although speculated to be in May, we think it'll take a little bit longer, but the supply-demand imbalance could be even more pronounced. There are currently 7 applications for ETH ETFs, including BlackRock, which has the largest new Bitcoin ETF. While supply of ETH is not capped, like Bitcoin, ETH is currently deflationary, meaning the protocol is burning more tokens now than it is issuing. Exchange balances for ETH stand at only 11% of total supply, or 13 million tokens, which is only $50 billion notional. What separates ETH from Bitcoin is its functionality, and we believe that a significant amount of supply will remain off exchange. An estimated 30% of ETH supply is locked in smart contracts. As we saw Bitcoin rally significantly on the potential for ETF approval, as well as following ETF approval, we think that if the ETH dynamic were to play out, we could see a similar path forward up before and significantly higher after. Thanks, Kathryn.
Thank you, Eric. Finally, we'll move to Josh Cannington, who, Josh, if you can explain to us your client base, I find it particularly interesting. Josh is an interest rate derivatives, and his client base is the commercial side. So, Josh, can you talk to us about your rate strategy, your views, and a little bit about your clients that you cover?
Yeah. Thanks, Kathryn. So from the perspective of our commercial clients, I think those are all primarily in agriculture, right? So all Dodd-Frank end users, boots on the ground farmers, producers, and it spans the whole cross of the spectrum of sophistication. Some folks as little as 5 to 10 million in operating note debt, others with 3, 4, 500 million at any given time, right? So they continue to hedge their floating rate risk pretty cautiously right now. And what we like for them and what we've been advocating for and see a majority of these pay fixed swaps being added is on the front end of the curve. 1-3 year tenors, I'd probably say 60 to 70% of the flows we see are on the front end of the curve like this. And oftentimes they're being combined with short caps, even 535 short SOFR caps, 555, with the intention to lower that fixed rate and improve the positive carry that those fixed rates offer. But to be fair, given the recent sell-off the start of this year, now with the forward curve basically right on top of that December dot plot, that positive carry is really starting to shrink for those pay fixed positions. And to that end, it feels a bit like we're picking up pennies in front of a steamroller in that market, because of a lot of our clients look at this same inverted curve that we have today with some deja vu of 2019, right? Where they went out chasing the cheapest fixed rate they could. They tried to save as much money as possible on their interest rates, only to be caught offside a year later when floating rates were back at zero, and most of them woke up to margin calls with the same sticker shock that a new combine goes for. And that's not to say we expect to see zero bound rates anytime soon, but given that recency bias, it is driving hedging strategies today in the commercial space. Everything's staying short dated, notional sizes, lean conservative, right? Further out, more in the belly of the curve, we see a lot of option use, right? So some callers out there, 3 to 5 year costless callers. Any pay fixed interest we see out past 4 or 5 years will oftentimes get a long floor or long put option embedded in it as like a safety net of sorts. Again, mindful of the mark to market losses that oftentimes come top of mind. And I think as a desk, the use of options and what would otherwise be vanilla structures is what we do very well. The long end, very few attention. Some people like the receiver out that far, but the volume is light in the commercial space. If I think that the 10-year got over 450 again, I'm sure that tone would change pretty quick. But being mindful of time, Kathryn, I'll just conclude. I think the overall consensus view and the risk management approach that we like for most of our clients is just don't ignore the risk of reaccelerating inflation and or the Fed just not cutting at all this year, right? So maybe 2-year fixed rate sub 450 versus overnight SOFR at 530. That seems like a good balance of risk and reward for our commercial clients. Ideally, if you could get the holistic interest rate positioning to a 50-50 mix of fixed floating, where you're kind of agnostic on where rates go from here, do it, right? At least until the next chapter for the Fed becomes a bit more clear. So thanks again, Kathryn. I'll pass it over to you for any closing comments.
Well, Josh, that was a wonderful end to our inaugural StoneX live stream for our annual outlook, where we delivered our views from that publication that we got out in January. And Josh, that I think it was a perfect circle. We started with rates, we ended with rates. Thank you to the entire audience who joined us. All of the questions that you submitted will be sent to the corresponding analyst, and that person will get in touch with you directly to answer your questions. Thank you very much for joining us again, and see you next time.